Good morning, everybody. You are watching live daily market outlook from Windsor Brokers for Monday, 13th of May 2013. We are at the beginning of the new week after a quite turbulent previous week, which has the main characteristic of US dollar gaining strength against most of majors as well as commodities, and the most significant gains were seen against Japanese yen and as well as Aussie dollar. Euro slipped as low as 129.50 approximately during the last 129.34 exactly during the last Friday's trading, consolidating briefly above these levels, but still being capped under 130. British pound against the dollar currently attempting at 153.80, still below previous break point at 154.10 after hitting a fresh low at 153.13, with the downside being again more focused. For dollar yen, as many analysts say, the sky is only limit. A brief corrective action is now underway after overnight's repeated strength and the attempt above important 102 barrier that so far keeps the upside limited, but it seems that it's a matter of time when the pair will break and resume the recent bull rally that commenced on a break above psychological 100 yen barrier that kept the upside limited in past couple of weeks, and several attempts were seen unsuccessful. Final break higher sees strong extension higher above 101 and now 102, with the current strength being fueled by a lack of stronger criticism from G7 group that had a meeting during the weekend. Stronger criticism of the recent very aggressive Japanese central bank action that was criticized heavily by the some officials and traders at the beginning when the yen was pushed lower of its recent fresh highs, and now the lack of criticism sees that the thing has passed, and the Bank of Japan made the proper move, and there is not going to be any more criticism, with the dollar yen currently standing at 101.56. 101 is the initial support, psychological support. Then we have Fibonacci levels at approximately 101.80 and 101.40, with the dips not expected to extend in any case 100 support. Though, pardon, Aussie dollar, as said, this was one of the top losers. The pair broke parity level on Friday's trading, dipped as low as 99.60, with the current consolidation being broadly limited by the parity level. Slight break higher and ticks higher were not longer lasting, seeing again more focus towards the downside, with the negative structure on the lower time frame studies supporting the notion. Crude oil from the commodities holds steady after last Friday's dip to 93.37 and quick recovery up to 96.20, with the hourly structure being slightly now negatively aligned following the last Friday's break below the consolidation range floor that was around 95.00, with the fresh weakness and slight gap lower seen on the overnight's opening, and the extension down to 95. Again, seeing slightly more potential towards the downside, with the 4-hour indicators again losing traction. Gold was one of the quite active instruments and performers of the last week. A sharp sell-off seen during the European session, triggered by heavy sales of the gold futures, pushed the yellow metals price below our strong support and psychology and the range floor at 1440, with 1420 seen as the lowest level, and then quick recovery emerged out of the dangerous zone and regained approximately 1450 area. However, negative tone persists as the fresh weakness seen at the beginning of Asian session, and the fresh extension down to 1425 sees increased the downside pressure and the more risk towards the downside, as break below 1425 and our new strong support at 1420 would open another strong support psychological level at $1,400 per ounce. Overall, dollar remains strong against majors and commodities, with the coming week seeing a lot of action in the markets as the calendars are full for each day of the week, and a number of important releases are seen in the coming week. So I think we will not lack any action in the week that starts today. To take a look now, we're going to take a look at today's calendar. We already had the important releases seen during the Asian session. Business confidence from Australia came at -2, disappointing compared to 2 in month of March. Home loans came at much higher than the previous release of February, 2%. Today's release was 5.2, with forecast standing at 3.8. Top releases, one of the day's top releases are Chinese data. Industrial production came slightly below the expectation at 9.4%. 9.3% was today's release, but well above March's release at 8.9, showing that Chinese economy is standing on the healthy hands. However, from the other side, no significant improvement seen in the retail sales for April. It came according to the forecast at 12.8%, and above the previous release that was at 12.6%. Swiss retail sales are out and are disappointing -0.9% compared to 2.4% in the month of February, and the 1% forecast. Sharp fall in the retail sales seen in Switzerland in March. Still to come, U.S. retail sales that are due at 12:30 GMT. April release, -0.3% is forecast for monthly April release for retail sales, compared to -0.4% release of March, while core retail sales are expected to show slight improvement. -0.1 is the forecast compared to -0.4 of March's release. Business inventories from United States for March are due at 1400 GMT. 0.3% is the forecast compared to 0.1% in February. Another retail sales due at the end of the day from New Zealand. First quarter retail sales are forecasted at 0.9%, quite disappointing compared to the fourth quarter of 2012 when the retail sales hit 2.1%. Core retail sales are forecasted lower again than the previous release of fourth quarter. 0.7% is today's consensus compared to 1.5% in the fourth quarter of 2012. And these are the highlights for today. So we have the retail sales as the main releases, with the coming days having a much more busy calendars and promising a lot of actions in the market. From a technical outlook for majors and commodities that you are expecting most likely, we are going to start with the euro dollar as our number one pair, and we'll see what we can expect today. Overall, a negative tone persists as shown on the hourly chart, with brief, I would say, consolidation seen off last Friday's fresh low at 129.34. This marks exactly 61.8% Fibonacci retracement of rally from a double bottom at 127.50.44 up to 32.41. Now the dip on Friday has broke below 200 days moving average that currently stands at 129.85, and the previous range floor at 129.53, but a quick recovery seen on Friday's trading regained these levels. Closed above weekly close was at 129.88, slightly a few ticks above 200 days moving average, and above the previous range floor that both have been cracked, but there was a lack of a clear break. However, a recovery attempt was limited under psychological 130 barrier, and fresh weakness now commenced at the beginning of European session, again seeing more potential towards the downside, and negatively aligned short-term, near-term, studies as on both 1 and 4 hour chart see further risk of further downside risk and the potential of break lower, as loss of recent low at 129.34 posted the last Friday is expected to open 5th of April low at 128.99. This is also a psychological 129 support, and then the next one will be Fibonacci 76.4% retracement level at 128.61. On the upside, as said, 130 still stays intact, and this is our initial resistance from the last Friday's low at 129.34. Then we have dynamic resistance 130.27, 55 days exponential moving average, along with the 130.33, 38.2% Fibonacci retracement of the entire down leg from 131.93 of May high to 129.34 10th of May low, with the 130.50 last Friday's high and 130.64 50% Fibonacci retracement seen as a break point, and for now expected to limit any stronger action higher, while break above these levels would signal that immediate bears will be sidelined and allow for some stronger recovery. At this point, this looks quite unlikely, as the downside pressure increases and the price slid so far to 129.50. However, any stronger corrective action would require break above 130.50-60 pivotal zone in order to avert immediate downside risk and open way higher, where we have 130.94, 61.8% retracement, along with the psychological 131 barrier break, of which is set to revive bulls and shift focus again towards the upper targets. Otherwise, likely scenario set according to the current structure in the near-term studies would be further weakness and the test of our next good support at 129.00, in case, of course, with break below 129.34 seen as initial step. British pound shows the similar situation like euro, as formation of double top on the hourly chart at 155.90 triggered. This was on last Thursday. Triggered fresh acceleration lower, with the price losing supports at 155, 154.45, and then extending losses so far to 153.13, just ahead of psychological 153 support. Break below also 153.51, which is 61.8% retracement of 151.95 to 156.03. Rally sees again more pressure towards the downside, as both 1 and 4 hour indicators hold well in the negative territory, with the brief recovery attempt so far being limited under our initial resistance and the previous strong support and break point at 154.10. As long as we hold below this level, more focus is still seen towards the downside. A break below 153.13, which is the last Friday's low, and 152.91 as 76.4% Fibonacci retracement of 151.95 to 156.03 would risk extension lower, and the test of our key support in the short term, which is 151.95, the trend line, the low of 23rd of April 2013. Before we move to this level, I have to mention also that main bull trend line drawn of 148.30 12 March low has been cracked on last Friday's dip, though so far holding the downside protected. Violation of the trend line that currently stands at approximately 153.38 would risk extension through 153.13, 152.90 towards our key short-term support 151.95. As said, that break of which is required to confirm the top at 156 zone and to signal an end of the corrective action from 148.30 that was so far capped at 156. 152 zone also marks 50% retracement. Exactly, the level is 152.17 of entire rally, and a potential break lower would be quite risky for a further extension towards the downside, where we'll be looking for a 151.25, 61.8% retracement, and then 151 psychological support. Alternative scenario requires a break above initial strong resistance at 154.10, and then regain of the next significant barriers where we have 38.2% retracement of the down leg from 155.90 to 153.13. That stands at 154.17, so just above this resistance, and is reinforced by descending 55 days hourly 55 days exponential moving average. And then our breakpoint stands at 154.50 zone, last Friday's high, and the 50% retracement of the entire down leg, break of which is to confirm the near-term bottom at 153.13 and allow for some stronger recovery. That will also avert immediate downside risk. Otherwise, more focus is still seen towards the downside, and the levels, as we mentioned, 153.13, 153.00 are the immediate targets, with the pivotal 152 support and strong support as seen in the near-term focus in case of a bearish extension below 153.00 support. As said, the dollar yen is still a star performer, with the brief corrective action seen during at the beginning of a European session, as the pair overnight opened with a slight gap higher and ticked again above 102 barrier at 102.14. That was all seen so far compared to the last Friday's extension to 101.97, few ticks ahead of 102, and then a brief pullback down to 101.50 before the fresh strength. Now 101.50 has been tested, already tested, with the support being offered at this point. Further extension lower is not ruled out, as our indicators are heading south, and 101.31 is seen as the next support that marks 23.6% Fibonacci retracement of the up leg from 98.63 to 102.14, with the more significant levels seen 101 as psychological support, and then 100.80, 38.2% retracement, and reinforced by ascending 55 days exponential moving average. And next levels in case of break are at 100.38, that marks 50% retracement, while dips, any stronger dips should stay contained above 100 psychological barrier, previous stronger resistance now acting as support, in order to keep immediate structure in bullish structure in play. That is seen as a quite likely scenario, as the pair usually goes in the strong movements, whether up or down. In this case, we have strong uptrend for a longer term, and if we compare the latest rally that commenced from 4th of April 92.72, the length of this rally before the pair entered the consolidative corrective range trading, now starting the new up leg, bull leg from 100, length of the previous rally could see the next leg higher to travel up to 105 or 105.50. That is seen as the next short-term target for dollar yen. Said Aussie dollar is one of the top losers against the US dollar's fresh strength, as the pair reached a fresh low on Friday at 99.60. As we mentioned previously, it broke below parity level after losing important supports and the multi-month range floor that was part at 101.14, as well as 101 psychological support, and the 50% retracement of larger rally from May 2012 at 95.79 to the range top at 106.23, high posted in September 2012. And now this opens a break below the range and weekly close below these levels, as well as denting the parity level, sees now more potential towards the downside, and the fresh bear phase has commenced at this point. We need to see the break below the recent low at 99.60 in order to have more clear picture that the bears are fully in play now, with the next targets seen at 99.00 as psychological and round figure support, and then 98.25, 76.4% retracement of the entire 95.79, 106.23 rally. Back to the lower time frames, quite extended the conditions on the hourly so far produced a brief consolidation that makes approximately triangular shape, with the upside being limited at parity level and 20 days exponential moving average. Again, more downside pressure is seen with the 4-hour indicators being again well extended, and RSI in the oversold territory still showing no significant signals of possible stronger recovery. In any case, any bounce higher needs to clear first the 1,000 psychological and the parity level, and then we'll be looking for a test of the next significant levels that stand from the Fibonacci levels. We have 10072, that is 38.2% retracement. Close to it is descending 55 days exponential moving average, while more significant is 101 barrier. It's last Friday's high and close to 50% retracement of the entire fall from 102.53 to 199.60, pardon. Break above previous resistance, previous strong supports, now acting as strong resistances at 102.20, which marks the previous base, and 102.50 that marks last last Thursday's high at 102.50. Last Thursday's Friday, I'm okay. With at 102.53 is required to ease immediate downside pressure and the open way for possible stronger recovery. Otherwise, more focus will be still seen towards the downside as downside pressure continues, and the pair is so far unable to regain even the parity level. Most likely scenario is fresh attack at 99.60 and break here to open 99.00, and our next Fibonacci expansion levels 98.76 is 138.2% Fibonacci expansion of the wave down, third wave from 103.83 high of 30th of April 2013. And finally, quick look at the commodities. Crude oil, as said, is in the near-term corrective mode of the last Friday's low at 93.37, with the gains being capped at 96.20, and since then the price dipped, is under pressure and dipped to 95. That this marks previous consolidation range floor, and being so far dips being contained here. Now the hourly structure is showing some signals, some positive signals, as a strong momentum has been regained, but MACD is still in the negative zone, and RSI moves rather sideways at this point. From the 4-hour chart indicators, loss of traction is evident, as all indicators are still heading south, and the loss of initial bullish momentum sees again increased risk towards the downside, with the 20 days exponential moving average so far limiting upside at 55, while the 55 days one at 94.76 so far offers good support. Any break here and a more significant 93.37, which is the low of last Friday, along with the loss of psychological 93 and the 92.83, 38.2% retracement, would risk a deeper reversal and deeper retracement of the recovery rally from 85.90 that peaked at 97.12. On the larger picture, bulls remain still firmly in play as the bull trend line drawn off recent low at 85.90 so far holds the downside and keeps more focused towards the upside. But from the upper side, we have the bear trend line drawn off 100.72 high. This is the peak of September 2012. That so far limits the upside, and the break here basically is required to open our next upside target at 97.68, peak of 1st of April 2013. And finally, the yellow metal that escaped from the temporarily escaped from the negative scenario of possible fall below 1420 and the test of next psychological support at 1400. Recovery was short-lived. Friday's strong rally of 1420 low to 1449 was short-lived as the price, despite closing at these high levels, still lacked any momentum and strength for further recovery, with the fresh weakness seen during the Asian session, dipping as low as 1425. Now the negative tone that dominates on the hourly chart still keeps the downside vulnerable and sees increased downside risk towards 1425 and 1420, break of which is to open our next significant target at 1400 psychological support. Conversely, any break higher requires again a regain of 1449, Friday's high. That is also acting as strong resistance. That also marks 50% retracement of the entire down leg from 1476 to 1420, and is also reinforced by descending hourly 55 days exponential moving average. Overall, the upside remains so far well limited and capped, and any break above 1450 seen as initial requirement would still require break above another significant barrier, which is around 1462, in order to shift focus completely towards the upper targets. Otherwise, a more likely scenario is seen towards 1425, 1420, break of which is set to open 1400 psychological support. That is also 50% retracement of the entire recovery rally from 1321 to 1487, 3rd of May peak. Now the break below the 1440 double bottom and the near-term range floor indices again increase the risk towards the downside, with 38.2% retracement at 1442 so far, containing dips but coming under pressure. That would open 1404, 1400, the break of which is to signal an end of the recovery action from 1321, and confirm top at 1387, also 61.8% retracement of the larger down leg from 1590 to 1321, low of 16th of April 2013. Overall, more risk is still seen towards the downside for the yellow metal. As said, 1425, 1420 seen as the next targets, and then comes 1400, while on the upside we have 1450 and 1462 to be cleared in order to shift near-term focus towards the upside. And that will be all for today's presentation. Please, if there is any question, any suggestion or anything, please you can submit it to me now. Surprised that we don't have anything for Dow Jones, Euro, Yen, and silver, and whatever was coming in the lights in past sessions. However, we are at the beginning of the new week that promises, again, as I said, a lot of action. So we'll have enough time to analyze all of the instruments, as a full calendar for the coming week again sees potential for extension of the stronger market action seen during the previous week. I think extension is quite likely to happen with today's set retail sales being the main focus, and then tomorrow we're going to see the next day's calendar that is also quite busy. We're back tomorrow morning at the same time at 7 o'clock GMT, 10 o'clock local Cyprus time. Don't miss our live session. Whoever connected after the beginning and missed any part, this session will be shortly loaded in the YouTube. Our page is called Windsor Brokers Forex, where you can find a number of interesting posts and things prepared by Windsor Brokers. I wish you a nice beginning of the week, nice Monday, and of course a lot of success in your trading. Until tomorrow, I wish you good luck.